Quantum Marketing Radio, the marketing podcast for insurance agents and financial professionals.
And welcome to another episode of the Quantum Marketing Radio. I'm your host, Louis Hillman, alongside the leveraged marketing guy, Jeff Thompson. Coming to you again from our Top Producer Conference in Scottsdale, Arizona, we have the pleasure of welcoming Amanda Eldridge from First Insurance Funding Corporation to talk today about premium financing. And premium financing is probably the topic that gets the most questions out of anything we bring up to our producers, and I'm sure you get more inquiries about how it works and why it's important than you know what to do with.
Right, and I think financing can be as complicated or as not complicated as you want it to be, but it can be daunting when you're first looking at it and have never done the case.
Well, we obviously are talking how we can help our agents market, and Jeff is always talking about scaling up. And, for somebody that hasn't approached premium financing as a solution for their clients, what are you telling them? Why should they be considering it?
I think they should be considering it like they would if they were buying a house or a car. I mean, there's an established need for the policy or an established need for life insurance, and once they figure out how much insurance they need based on their goals and objectives, then you need to sit down and figure out, well, how do you want to finance it? Or how do you want to pay for it, right? You could write the check or you could finance it. So it's really just another option of paying for the premium. I think, a lot of times when you're think about when you're going to buy a house, that you find the house that you want that fits your lifestyle, fits your needs and objectives. You don't sit down and go, okay, so when are you going to write the check? Here's how much it's going to cost. You look and say, well, maybe they've got the funds to write the check, or maybe they would like to take out a mortgage and finance that house. It's the same principle, I think, with financing life insurance. When you really break it down, look and establish the need for life insurance, get the policy, and now decide how do you want to pay for it. And financing should be one of those options.
Yeah, and that's obviously the case if you're dealing with that affluent market. Does it make more sense for them to spend their own dollars, or is there too big an opportunity cost there where it makes sense for them to do the financing alternative?
We find a lot of the clients are really successful entrepreneurs, their businesses where they're earning double-digit returns. And so the last thing that they want to do is take money out of that business or that entity or that stock portfolio or whatever asset they have that's returning them, a really high return, to liquidate that to put into a life insurance policy. So for them, it makes sense. It's sort of that retained capital theory where, you leave the money where it's making the most for you and freeing up cash flow to do with what you want, instead of putting it into a policy, which you need. But it's a non-correlated asset, right? You're expanding your portfolio, and you need the life insurance and that it's a part of it. But you're keeping the money where it's making you the most.
Where is the market today? I mean, who are ideal clients? I mean, there has to be, I assume, a minimum net worth. Who are you guys looking to work with?
Yeah, our minimum net worth is $5 million or more. Now, that's not to say that's a hard and fast number. I mean, we'll certainly look at someone who's got really strong income, but maybe falls slightly below it. Our minimum premium to finance is $100,000 first year. So we cast a fairly wide net to be able to provide financing solutions. So we started $100,000 with really no maximum. So really it's going to be your, creditworthy client who's, got a fairly substantial net worth, or at least, has really strong income and their trajectory of their net worth is going up. That's where our ideal client is.
As far as how you do case design, I know you don't at this point because of your new role. And I was a little confused, when you showed up here. I'm like, who is this Amanda Eldridge person? But so let's just clarify that right now for everyone listening.
Yes, I'm formerly Amanda Zukowski. I was with NFP for 11 years and supported ECA as sort of the premium financing expert when I was with NFP. So I provided a lot of case design, point of sale, finding lenders, basically from consulting to funding. I was there for you guys. And so back in September of last year, I decided to become the money and jumped ship and went to go work for a lender. And I got married too, so it was a lot of changes in 1 year. And so now I'm Eldridge, but you can still call me Zukowski if you want to. I still answer to Zukowski.
Good. At least now I know who I'm working with. So my question, I guess, is really about what do you commonly see other than death benefit?
Mm-hmm.
How is a policy often used? Are people using this as a supplemental retirement strategy?
We're seeing that quite a bit, actually. Where I would say, and I'll talk about it tomorrow in our presentation. But the majority of the policies that are being financed are cash accumulation, and we're seeing a shift to younger age. So more than half of the new policies, right around 50% of the new business that we did last year were to clients who were age 50 and younger. I mean, that's a big shift. I mean, if you look at 2008, the average age of our client was 69 years old. And, fast forward to 2015, just, a short period of time later, the average age of the client is 51. So you're seeing accumulation sales where you're seeing supplemental retirement or potentially using the policy as a source of income down the road, whether it be to retire the loan from the premium finance or simply to provide a stream of tax-free income.
Or a pool of cash at a later date for the business to access.
Absolutely.
Okay, great.
Do you ever feel like you're competing against unfounded stigmas about the premium financing industry, maybe from...
Not as much anymore. I would say, probably 7 or 8 years ago, there was definitely the Wild Wild West. There was a lot of Stoli and Ioli that was done, with financing, and all of that's really gone. And I think, if anybody is encountering that, then they're probably playing game. It's not necessarily, it wouldn't be the stuff that we're looking at. But I think the stigma with premium financing is the idea that sometimes it's sold as free insurance, and that's not necessarily the case. It really should be just looked at as a way to leverage a client's current liquidity.
I'm assuming we're seeing less of that because of the shift towards this accumulation approach.
Yeah, you've got a whole new product base that's out there. I mean, if you look at where products were in 2008, I mean, in 2010, indexed UL was something like a little over half of the new business that we're doing, and now it's 3/4 of the new business that we do. So, wow. And I think, that shift in just 5 years is really because there are different products that are out there. They've really changed indexed UL to cover a wider range of clients. They're putting in lots of new features that really appeal to a larger market. It's not just the, under 45. I mean, you really can use indexed UL for a lot of different types of clients. And we've also seen an increase in whole life as well. So when you add those two together, both which are very accumulation focused, I mean, that's something like 98% of the new loans that we did in 2015 were.
Which is significant.
It's very significant.
It's not a death benefit focused strategy any longer.
No.
Which is really what predominated for quite some time. So.
Right. Yeah, I would definitely say don't look at premium financing as a loan for life type of situation. Certainly you can. We'll keep loans on the books as long as the client wants to, service the interest or keep that loan in play. We're more than happy if they can post collateral. We would finance it until they die. And death can be used as an exit strategy, certainly. But when you see a shift to younger age financing, someone's not going to finance a policy for 50 years. They're going to, I think a well-planned exit strategy is something they should go into at the inception when they're looking at financing premium, thinking, okay, what, asset am I earmarking that I'm going to liquidate, or, am I going to, sell a piece of property, or am I going to use the policy cash surrender value as a method of getting out of the loan? I think if they kind of know at the time, or I'm setting up a side fund, if they know at the inception of kind of where they want to plan it out and it meets their goals and objectives, then usually you're going to see, them financing it for a shorter period of time.
So as far as agents that are looking at getting into premium finance maybe for the first time, mm-hmm. What are some of the big risks that they're going to have to explain to their clients? What do you think the biggest risks for a client engaging in a finance case would be?
Well, there's loan rate risk, there's carrier risk, there's collateral risk. I mean, there's definitely, and then I think it really just depends ultimately, where is the client most risk averse? Do they feel comfortable posting collateral? Do they feel comfortable with a variable loan rate? Do they feel comfortable with the carrier that they've gone with? I mean, there's even carrier risk there. If a carrier's ratings drop, technically that could be a default provision. Now, most lenders, ourselves included, aren't going to just say, no, sorry, we're getting out of the loan just because that carrier rating dropped. I mean, we'll certainly work with the client, but there's always risks. Some of them they can control, some of them they can't. And I think really it's just sitting down with the client to say, here's the premium finance transaction. Now let's really ask some questions and say, let's look at your portfolio. Let's look at, what collateral do you want to post? Are you comfortable with, an interest rate environment where you have a variable loan rate that could reset on a monthly or annual basis? How comfortable you feel? Once you get the answers to those questions, there's really a lot of those risks you can mitigate. I mean, with a variable loan rate, you could potentially fix a rate or put in a cap. With collateral risk, you could say, well, then maybe you need a policy that has a guaranteed cash value rider, something that helps have them not necessarily tap into that extra liquidity, those types of things.
Okay.
What are some of the mistakes that you see? Maybe mistakes isn't the right word, but what are some of the the types of cases that agents bring to you that they think are viable for premium financing, and you take a look at it and peel the onion back a little bit and say, these are common reasons that it's not a viable premium financing case?
I would say the biggest one is taking a look at the client's net worth, and if the client can't afford to write the check, then they shouldn't be financing. Premium financing is not for the client who can't afford the premium, but for the client who can and chooses not to. I think that's the biggest distinction out there. I think a lot of times what happens is, the client is very illiquid and, would really have trouble just writing the check for the policy. And so they think, let's go ahead and finance it, that way we can reduce the impact on the cash flow of the client, and that's not really the case. I think there are other times too where you see that the client is, maybe has a substantial net worth, but maybe the trajectory, maybe they have fixed income, or the question I always say, will the interest payments and the collateral requirements substantially affect the client's standard of living? And if it's going to affect their standard of living, like substantially affect it or material affect it, then they may not be a good candidate for premium finance.
Are the clients paying 100% of the interest?
Typically, honestly, from a lender perspective, we're fine with deferring the interest as long as the client can post the collateral to support it. Really where you're going to see that is with carrier guidelines. You're going to see there are definitely carriers, Jeff, that will restrict whether or not the client can defer the interest or not. So mostly we see clients paying the interest, usually interest in advance. So they're just paying it at the beginning of the year for the year. But you certainly see it in a lot of different ways. They might pay it in arrears, like maybe on a monthly basis or a quarterly basis, or they might defer it.
I want to bring this back to a marketing perspective again. Looking into the next year or so, what do you see as the opportunity for premium finance in general? Where do you see the best growth?
That's a good question. I think, there's a reason why traditional premium financing has stayed the course, because it's always going to be a way for the client to free up their cash flow, whether or not, I think, one of the worries I think that a lot of people out there are thinking is, are interest rates going to go up? And of course, if I could get into my crystal ball and look in and see what it would be, it's hard to tell. I mean, interest rates are still historically low. And, obviously we're going into an election year, and markets have been fairly volatile, but at the same time, I would say borrowing rates have stayed fairly steady. I mean, they're slowly ticking up, but we're not seeing the type of, uptick in rates that we've seen. So I think the opportunity really is just having that conversation, because it's become very popular. I mean, it's being talked about quite a bit, and if you're not talking to your clients about it, or the producers aren't talking to their clients about it, then somebody else is. They're either hearing about it on the golf course, they're hearing about it at a happy hour, they're hearing about it at a conference. They're talking about it and wondering, well, wait a minute, why didn't my advisor tell me about this?
Well, I thought it was interesting that you said something earlier that most of the product that you're seeing now is actually index UL. So it's sort of there's this convergence of premium finance with a very hot market segment in the life insurance market that continues to grow, and this may be part of what's fueling that as well, because these are obviously not small, inconsequential cases. So
No, our average case size is $1 million. Now that doesn't mean that we spend just as much time as we do on a $100,000 case as we would on a $2 million case. That just tends to be where our numbers fall, in terms of the type of business that we do. But you're right. I mean, and the other thing that I hear a lot of times, from advisors and producers is that they'll, bring up the conversation or start talking about premium finance. I said, okay, well, based on the conversation that we've had before, where we've talked about the amount of life insurance you need, but here was your budget. How about we look at the actual coverage you need? Maybe it's, they could only, not afford, but their budget was to write for $5 million, but now they're at $10 million. Then now they can afford it by doing finance. I apologize.
And I know I personally have brought cases to you that, the agent was just shooting in the dark.
Mm-hmm.
That has to be frustrating for you, because I'm sure you get a lot of stuff that comes across your desk that you can probably tell early on that this is going nowhere. But you're asked to put your time and energy into these cases, as Jeff and I are, when you know that the agent doesn't know what he's getting into. Talk to me about just the frustration of,
It's not necessarily frustrating. I would say use me as a filter. I mean, the last thing I want is for, the advisor to end up being frustrated with the process. And I'll be brutally honest. I mean, if there's a case, send me the I got a guy scenarios. Let's talk through it. And if, I really don't think it's going to fit the model or fit the mold, then I'm going to tell you straight out. But and I think too, it's an education process over time. When you hear about premium financing one way, or you hear about premium financing another way, and then you talk to your client about it, but then it doesn't quite fit the characteristics or the mold that in terms of us as a lender would accept it, then I could see how that would be frustrating. And I think sometimes too that advisors put the cart before the horse. They sell the financing before they actually sell the life insurance. And I really think you got to go in and talk to them about the life insurance, establish that, get that set, and then figure out how you want to pay it, and then structure the financing from there. And I think if you take that approach, then the quality of the cases that the advisor will bring in and want to send to the lender will be a lot better. I think if they do kind of that prep work, but more than happy to filter through some of those. And that's my job, definitely, is just to filter through all that. So, and I think over time, just from an education standpoint, just figuring out where are the opportunities, but what are the right questions to ask, because I think that's where probably some of the frustration is that they're not asking the right questions, and so they're not getting a complete picture or getting all the information. And sometimes the clients aren't giving them the whole picture either. They're coming and thinking, oh, this is a great prospect, and then we'll start to get into it and we'll start looking at financials, and turns out this client's like completely illiquid. They're tied up in a business that's they can't get access anything out of, and really they're just not ended up being a good candidate. So unfortunately what's happened is the advisor's gone in and sold premium financing before really being able to look at the finances and really see whether or not this client was a good client, was a good candidate for it. So now the client's like, wait a minute, but you told me I could get financing, and now you're saying I can't get it. And so I think that's where there tends to be frustration for everybody.
So if you were able to eliminate something that you don't like about the industry or premium financing in general, what would you want to change going forward?
Ooh, gosh, that is a good question. I will say that I feel like a lot of times you can get caught up in the rate game. Where because borrowing rates have been historically low for quite some time, that there's this race out there to get the cheapest rate, and this sort of theory that the cheapest rate means the best deal for the client, and it's not actually the case. I really think that when you get into the rate game, it might not always be the best deal, because the thing I always ask is, well, that's a great rate, but what's the cost?
What are the rest of the terms? And
no, I would just say that it becomes, let's chase the rate. And when you get to that, then you go, well, what strings are attached to that rate? And when you start looking at the fees, the restrictions in the loan documents, essentially making it very inflexible for the client. And if they're not really asking the client and looking at the overall structure of the financing, then rate becomes a non-factor. I mean, rates are going to be good regardless. They're still very well below their historical highs or historical averages. So, then I think you got to get to talking about structure.
well, that comes back to, was it sold right? Did they sell the life insurance? Do they have the right kind of prospect? Is it someone where they can write the check and it's an opportunity cost situation?
Right.
Or are they just struggling to find a way to pay for what they need in terms of life insurance? So if they've got the right client, hopefully, and they've sold the life insurance properly, hopefully they're not so focused on the rate game, because then it just, does this make sense?
Right.
From an opportunity cost standpoint to finance it. So
I think agents that are going to be engaging in this podcast, that premium financing is almost like a foreign language to them, would benefit from hearing the basics of what are the steps when, start to finish, where does first funding come in the process, and just kind of laying out a 101.
Sure. And I'll tell you from the perspective of First Funding, and we're a slightly different model because we are a direct lender. So we don't work in a broker capacity. We're not what we call an aggregator, which means that we would shop it out to multiple lending sources, nor are we a program where, we have, specified, sort of entry costs, or we'll take a split of the case. We are a direct lender. We are a bank. So you can come direct to us as a lender. So that, just to kind of lay that groundwork. Once the client said yes, and you want to move forward with financing the premium, what we have a credit application and a broker profile. You would send it to our new business team, and I'm more than happy to send all that information out. We can talk about that tomorrow. And so what happens is, once that credit app goes in, and I would say the more complete package you have to send into new business, the easier the process is. And we have a great little process document that I can actually share with everyone that kind of talks about the pitfalls along the way, things that you should anticipate so that you reduce the frustration. So what happens is, it goes into our new business team. New business team reviews the information, and that means financials, tax returns, everything that's been sent in, proof of liquidity or verification of income, that kind of thing. Assuming that we have everything and everything's in good order, we would send out an offer letter. And the offer letter would state our terms, and we're very transparent. So we don't charge any fees, we don't charge any prepayment penalties. There's no additional cost other than what the rate is. So that goes out. Client says yes, I'm ready to move forward. Signs the offer letter, sends it back in. We start to prepare documents, and so we prepare a loan package. We send out the loan package, start getting the collateral assignment, make sure everything's set to go with the carrier, with the product. We need verification of collateral. We get all of that signed. They get everything signed in. Once we do that, we get the signed collateral assignment from the carrier. We're ready to fund. And I mean, I've simplified it a little bit, because a lot of times, there can be some holdups in the process. A lot of times when you're, maybe the client, is taking a long time to sign, or maybe they need their lawyer to review it. More than okay with that sometimes we'll stretch out the process. Sometimes if there's multiple policies involved and we have to get multiple collateral assignments, or maybe it's a carrier that we haven't worked with, and so we have to have that, get sign off, or the carrier sometimes has to sign off on our collateral assignment form, those types of things. Those are some of those little things that can happen along the way. But really, I mean, it's just the quality of the information that we have. We review, say, once we send out an offer letter, subject to the terms, we're more than happy to get that loan package together, get it signed, and fund that premium.
what are the biggest glitches that sabotage a case that's been submitted? Is it getting a letter of credit? Is it, what are the common things that you see that sort of...
Just not sending in enough information. A lot of times, and on occasion we'll do what we call a conditional offer letter. So, we'll say, based on the information we've seen, we feel comfortable putting it out, but this isn't set in stone until we have these items, that kind of thing. But a lot of times it's just, not being, or what'll happen is what they've stated on their personal financial statement doesn't necessarily match up to what they're able to provide to support the items that they've put on there. Sometimes it's, sometimes a glitch is that they've had a bankruptcy, or, we do need a credit-worthy client. Someone's had a lot of, issues or has bad credit. Obviously as a bank, we're not going to necessarily want to lend them $1 million. So, those types of things come up. Sometimes it's, comes up and is a collateral issue. We'll get down the road and we'll go to say, hey, your additional collateral due, here's what we need. And then the client's like, I don't know if I want to put that up there anymore. So those are sometimes some of those things come up, but most of the time we can work through them.
Okay.
Letters of credit actually one of the easiest form. It's nice that you brought that up, because we do take a letter of credit and that's what's most commonly used. For additional collateral due, because it's very easy for the client to get a letter of credit.
Mm-hmm.
And we have assignments with most every large institution.
What about, working with agents that are motivated by the supersized commission? We're looking at 5 or 10 times the normal commission for an agent, which could be a good thing.
Mm-hmm.
But people that are motivated to pad their own pocketbook and maybe not approaching premium financing because it's really the right solution for their clients. Do you run into that?
Sure. We just will, but we stay very agnostic. So we will review the situation based on purely from the lending perspective, and we'll leave the life insurance to them, and how that works. And a lot of times if that is happening, usually cracks will start to form. If it's sometimes if they're trying to borrow way more than their net worth, we see that. That's obviously not something that's going to continue to move forward. We'll do our due diligence from the lending side, and if there is something where either the client's being oversold, somewhere it comes along. If either from the carrier side or from our side, then we'll find the chinks in the armor. We'll put it that way.
Well, it looks like we're actually heading into pretty close to our 30-minute time frame. So
that was a quick 30 minutes.
Time flies, actually, yeah. So
when you're having fun talking about premium finance, yeah.
The exciting world of premium finance.
I know. Everybody's jealous. I'm sure they want to do this now.
Well, that's kind of the goal. Is hopefully we get you a little, enticement by having your interview on our podcast. So. Well, anyways, I think we're going to just come and wrap it up. But if there's one piece of advice to a new agent that's trying to start off with their first premium finance case, what would that be?
I would say seek resources. Utilize the resources at ECA. Leverage leverage is a great word. Leverage ECA's relationships and contacts, and educate yourself. There's a lot of resources out there really to talk about the concept. The concept itself is not. I don't think it's a very complicated concept. I think it's made complicated. And then, once you've started to have that conversation, really educate yourself on the process. And I think, being able to tap into the resources at ECA is going to be a huge benefit.
Great. Well, thanks, Amanda, for being on the podcast today.
Thanks for having me, guys.
Are you independent? Be a part of the cutting edge in fixed life and annuity marketing for the independent agent and advisor. Discover the ECA Advantage, where you'll find the marketing systems, training, products, compensation, and expert support you need to take your business to the next level. Sign up for your free ECA agent account to get access to ECA's Knowledge is Power 2016 Keynote Speaker Video Series. For more information, call ECA Marketing today at 800-356-4189 and ask for your marketer, or visit ecamarketing.com.
Thank you for downloading our podcast. Find out more about the Quantum Marketing System at quantummarketingsystem.com.